evening, students. Today we are going to start our next topic of admission of a partner. The new topic which we are going to start is, at the time of admission of a partner, what will be the accounting treatment of goodwill. So whenever a new partner joins the partnership firm, that partner will bring his share of capital as well as goodwill, his share of goodwill in the firm. So the capital which is invested by a new partner in the partnership firm and the goodwill which he is bringing in the partnership firm, it depends upon the new partner how much capital he is bringing to the firm. So next case is that when a new partner is bringing his share of goodwill to the partnership firm, what will be the accounting treatment at that time? So basically there are three cases for the goodwill, for the accounting treatment of goodwill. Whenever a new partner joins the partnership firm, he or she will bring share of goodwill, and that share of goodwill will be given to old partners in their sacrificing ratio. It means the new partner will bring his share of goodwill, and the share of goodwill which he is bringing in the partnership firm, it will be given to old partner or existing partner. It means the partner who are sacrificing in the sacrificing ratio, they will get the share of goodwill which the new partner is bringing in the partnership firm. So basically there are three cases. First case, when premium for goodwill is paid privately. It means whenever a new partner is joining the partnership firm and he or she is paying the share of goodwill privately to the partner, means outside the business he is paying the share of goodwill to the partners, in that case no accounting treatment will be done in the books of the firms. Second case, when the new partner brings his share of goodwill, and he is bringing his share of goodwill in cash. So this is the second case. Premium for goodwill. He is bringing premium for goodwill in cash. In that case, what amount he is bringing, firstly we have to consider that thing. And when he is bringing the share of goodwill in cash, so that share will be given to the existing partner. Given to existing partner means the partners who are sacrificing, and the sacrificing partner will get the share of goodwill in their sacrificing ratio. And third case, when new partner does not bring his share of goodwill in cash. This is the third case. When new partner is not bringing his share of goodwill in cash, then what will be the accounting treatment? So step by step we will continue with these three cases. First case, when the premium of goodwill is paid privately by the new partner to the old partners, to the sacrificing partner, no accounting treatment will be there. So in this case we will not do any accounting treatment. Now we are moving to second case, when premium for goodwill, new partner is bringing premium for goodwill in cash. Then what will be the accounting treatment? So first journal entry of second case, when the person is bringing his premium for goodwill in cash. So in business, cash is coming, cash or bank account debit to premium for goodwill. Now second journal entry, when a person is bringing his share of goodwill, now premium for goodwill is brought in by the partner, new partner, and this goodwill is distributed between old partner in the sacrificing ratio. It means the partners who are sacrificing, they will get this share of goodwill. So journal entry will be premium for goodwill account debit to old partners capital account, and in their sacrificing ratio they will get the share of goodwill. Now old partners capital account or sacrificing partners capital account will be credited because they are getting the share of premium for goodwill. That's why their capital account will be credited. Now this is the second case. Now if these old partners are retaining the share of premium for goodwill in the business, we'll pass these two journal entries. Now if the partners are withdrawing the share of goodwill, suppose both the partners, suppose two partners are there, two old partners are there, and they are getting 20,000 and 15,000 as a share of goodwill. Now they are retaining the share of goodwill in the business only. So we'll pass this journal entry. And if one more statement is there, that if the partners are withdrawing the share of goodwill from the business, then we'll pass one more journal entry for the withdrawal of the share of goodwill. Now another journal entry when they are withdrawing withdrawn of premium for goodwill. Now in this journal entry, what we will do, old partners capital account will be debited and cash or bank account will be credited. Journal entry will be old partners capital account debit to bank or cash. If they are withdrawing the whole amount of premium for goodwill from the business, then their capital account will be debited by the same amount. If they are withdrawing some other amount from the business, then we'll debit their account with that particular amount only. So this is the accounting treatment for premium for goodwill when new partner is bringing his share of goodwill in the business in the form of cash only. Now move to illustration number 21. A and B are partners in a firm sharing profits and losses in the ratio 3:2. Their capitals are 1,80,000 and 1,40,000 respectively. They admit X in partnership on the condition that he will bring 67,500 as goodwill and rupees 1,50,000 as capital, and he will get 1/4 share in the profits of the firm. Assuming that the capital and goodwill have been brought in by cash by the new partner, pass the necessary journal entries and find out new profit sharing ratio of the partner. First case, when goodwill is retained in the firm, and second case, when goodwill is withdrawn by old partner. Now in this question, what is given here? A and B are two partners. The profit sharing ratio between A and B is given 3:2. They admit X as a new partner and X will get 1/4 share of the profits. X will get 1/4 share of the profit, and for this share, X is bringing 67,500 as goodwill. Goodwill means as premium for goodwill, and X is bringing 1,50,000 as capital. These two things are brought in by X in the business. So what we have to do, we have to find out a new profit sharing ratio, and secondly we have to find out, we have to pass the journal entries when goodwill is retained in the firm and goodwill is withdrawn by old partners. First thing which we will do in this question is to find out the new ratio. So as we know that if only old partners share is given and new partners share is given in the question and no other information regarding profit sharing ratio is given in the question, then what we will do, we'll find out the remaining share after giving share to new partner. So first what we will do, let we'll assume total profits is equal to 1, X new partner's share 1/4, and then after giving share to X, remaining share 1 minus 1/4, that is 3/4. Now A and B will get the remaining share in their old ratio. So this will be the new ratio. So A's new share will be 3/5. A's old share is 3/5 and B's share is 2/5. A will get 3/5 share of remaining share. 3/5 of 3/4, 9/20. B's new share will be, B will get 2/5 of remaining share, that is 3/4, that is 6/20th, and C's share is already given, that is 1/4. So new ratio between A, B and C will be 9/20th, 6/20th and 1/4. We have to equalize all the denominator. So we'll multiply 4 with 5, numerator and denominator with 5. So ratio will be 9/6/5. So this will be the new ratio of the partners. Now next step is to calculate sacrificing ratio. Why we are calculating sacrificing in this question? Because it is not asked to calculate sacrificing ratio in this question, but we have to find out because new partner is bringing his share of goodwill, premium for goodwill in cash, and this share of goodwill will be given by new partner to old partner in the sacrificing ratio. Now you have to remember one thing. If new share is not given in the question, only these things are given. A and B's old share and X new share is given only in this question. So we have to remember one thing, that old share of A and B will be their sacrificing share. A old share of old partners will be considered as their sacrificing share. So what will be the sacrificing ratio? It will be their old ratio, that is 3:2 between A and B. When we have to take this thing, consider this thing, when new ratio is not given and only new partner's share is given in the question. So next step is to pass journal entries. Now we have already calculated new ratio. Now next step is to pass journal entry case 1. First, when a new partner is bringing his share of capital and goodwill in business. So first journal entry which we have to do is, for bringing his share of goodwill, journal entry will be bank account debit to X capital account to premium for goodwill account. Premium for goodwill and capital is brought in by new partner. So he is bringing 1,50,000 as capital and 67,500 as premium for goodwill. So amount will be 2,17,500. Total amount 2,17,000 he is bringing. Now in second journal entry, the new partner will give this 67,500 to A and B in their sacrificing ratio. So next journal entry will be premium for goodwill account debit to A's capital to B's capital. How much A will get? A will get 2/5 of 67,500, 13,500 into 2, 27,000, and B will get, 3/5. He is getting 3/5 and 2/5. He is getting 27,000, and A will get 13,500 into 3, 40,500. Next case, case 2. Now this is case 1, when both the partner in total of 60,500, we will write down 67,500, we'll write down here. Now second case, when the premium for goodwill is this is the first case, when premium for goodwill is retained in the business. Now second case, when the partners are withdrawing the share of goodwill from the business. So what we will do, we'll debit the partner's capital account because they are withdrawing the whole amount of premium for goodwill from the business. So journal entry will be A's capital account debit, B's capital account debit to bank. If they are withdrawing whole amount, then 40,500, 27,000 and 67,500 net. So this is the illustration number 21, and in the second case these two journal entries remain same and we have to pass one more journal entry. But in case 1 we'll pass these two journal entries only. Now we are going to start our next illustration number 22. X and Y are partners sharing profit and losses in the ratio 2:1. They admit Z into partnership with 1/4 share in the profit which he acquires equally from X and Y. Z brings in rupees 1,65,000 as capital and 30,000 as goodwill in cash. Pass entries and calculate new profit sharing ratio. So what is the summary? Now in this question two partners are here, X and Y, and the profit sharing ratio is given 2:1. They admit Z into partnership firm with 1/4 share of the profits which he acquires equally from X and Y, and Z is bringing rupees 1,65,000 as capital and rupees 30,000 as goodwill. What we have to do in this question, we have to calculate new ratio and journal entries. This is the question. Now two partners are here, X and Y. Old ratio is given, new partner's share is given. It is mentioned along with this new ratio, new share, that Z acquire 1/4 share from X and Y equally. It means both are sacrificing equal shares. So actual what they are sacrificing, we have to find out that thing. Now we know while passing journal entries that they are sacrificing equal share. So when we will distribute premium for goodwill between partners, we have to distribute it equally. But to find out new ratio, firstly we have to find out their sacrificing share. So first thing, X sacrifice half of 1/4, that is 1/8. Y sacrifice half of 1/4, that is again 1/8. Now next step is to calculate new ratio. X का new ratio calculate करेंगे. X old share is 2/3, old minus sacrifice made by X 8, LCM is 24, 16 minus 3, 13/24. Y's new ratio will be old 1/3 minus sacrifice made by Y 1/8. LCM is 24. 8 minus 3, 5/24. 5/24. Pause. And Z's share will be, which is already given here, that is 1/4. Now we'll find out the ratios. X, Y and Z. X share is 13/24, Y's share is 5/24 and Z is 1/4. As you know, we have to equalize the denominator. We have to multiply it by 6. So 13:5:6. This will be the new ratio. Now first question is done. New ratio we have calculated. Now we will move to journal entries. So first journal entry, when Z is bringing his share of capital and goodwill in the business. So first journal entry will be cash or bank account debit to Z's capital account. How much is bringing as capital? That is 1,65,000. To premium for goodwill, that is 30,000. So total amount is 1,95,000. This is the first journal entry. Now second journal entry, when this premium for goodwill is given to old partners in the sacrificing ratio, it is clearly mentioned that Z is acquiring 1/4 share equally from X and Y. It means they are sacrificing equally. So we have to give this premium for goodwill to partners. So journal entry will be premium for goodwill account debit to X capital account to Y's capital account. Now we are giving this share equally to partners. Total 30,000 they are getting, and their capital account will be credited by 15,000 each. Now we are going to start our next illustration, that is 23rd. Ram and Shyam are partners. Their profit sharing ratio is 3:2. Mohan joins the partnership for 1/4 share in the profit, of which he acquires 2/3 from Ram and 1/3 from Shyam. Mohan brings rupees 6 lakh for capital and 2,40,000 for goodwill. 1/4 of the amount of goodwill is withdrawn by old partners. Pass necessary journal entries and find out new profit sharing ratio. Now, two partners are here, Ram and Shyam, and their profit sharing ratio is given 3:2. Mohan joins the partnership firm. New partner is admitted for 1/4 share. And for 1/4 share, what is mentioned? That out of which he acquires 2/3 from Ram and 1/3 from Shyam. This is given. And Mohan brings rupees 6 lakh as capital and rupees 2,40,000 as premium for goodwill. Now, in this question, 1/4 of the amount of goodwill is withdrawn by a partner. It means whole amount of goodwill is not withdrawn by the partner. 1/4 they are withdrawing from the business. And in this question, we have to find out new profit sharing ratio, and we have to pass journal entries also. So, it is given here, two partners. One partner's share is 3/5 and other's share is 2/5. New partner is admitted for 1/4 share. अब ये 1/4 share कैसे ले रहा है? He is acquiring 2/3 from Ram and 1/3 from Shyam. Means out of 1/4, 2/3 he is acquiring from Ram. 2/3 जो उसका है वो राम से ले रहा है. So it means he is getting 2/3 of 1/4 from Ram. So sacrifice made by Ram, that is 2/3 of 1/4, 2/12. Sacrifice made by Shyam, that is 1/3 of 1/4, 1/12. So what will be the sacrificing ratio? That is 2:1. Now, after deducting this sacrificing share from their old share, we will get the new ratio of the partners. So, new ratio of the partners will be partner Ram, old share 3/5 minus sacrifice. You can do in this way 1/6, or you can write down the same fraction. 30 is the LCM. 18 minus 5. 13/30th. Shyam, old is 2/5 minus sacrifice made by Shyam 1/12. That is LCM is 60. 24 minus 5, that is 19/60. And new partner Mohan, Mohan's share is 1/4. So new ratio will be Ram, Shyam and Mohan. 13/30th, 19/60 and 1/4. So you will have to equalize the denominator. You will multiply it by 2 and 1/4 को multiply करेंगे आप 15 से. So ratio will be 26 by 19 by 15. This will be the new ratio. Now we are going to start with the journal entries. So first journal entry, where a new partner is bringing his share of capital and goodwill in the business. Journal entry will be bank account debit to Mohan's capital account. He is bringing 6 lakh as capital to premium for goodwill. That is 2,40,000. Total is 8,40,000. Now, second journal entry, when the premium for goodwill is distributed between Ram and Sham in their sacrificing ratio, and ratio is 2:1. So next step, next journal entry, premium for goodwill account debit total is 2,40,000 to Ram's capital account to Sham's capital account. How much Ram is getting? He will get 2/3 of 2,40,000, that is 1,60,000, and Sham will get 2,40,000 into 1/3, 80,000. Now next, it is given in this question, one statement is given that 1/4 of the amount of goodwill is withdrawn by old partners. It means they are not withdrawing the whole amount of goodwill, premium for goodwill from the business. They are withdrawing 1/4. So what we will do, capital account will be debited again. Ram's capital account debit, Sham's capital account debit to bank. Now out of 2,40,000, we have to make it 1/4. 80,000 total. 60,000. 60,000. They are total they are withdrawing 60,000. And how much R is withdrawing? 1,60,000 divided by 4, that is 40,000. And how much Sham is withdrawing? 80,000 divided by 4, that is 20,000. Total 60,000 they are withdrawn.